Hey, good morning, everybody. It's Thursday, July 16th, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products that help my originator friends get more business from Google, AI search, and social media. Check them out. We've got Originator Success, Grab and Go Social, and Rate Sensei. Something for each of you. So go check those out. Check them all out. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting to you on Facebook and on YouTube. This morning's lock advice is to lock anything closing in the next 30 to 45 days. Stick around with me for the next 10 minutes. I'll tell you why I feel so strongly about this. Again, lock advice remains lock anything closing in the next 30 or 45 days. Stick around with me and find out why. Remember, if you want to join me live each and every weekday morning, don't forget to sign up for a text reminder, hmmr.io/reminder, or use this cool QR code. I send out a text as I go live each and every weekday morning. You can also get our written lock advice at www.ratelockadvice.com. Sign up to get that email to your inbox each and every weekday morning. You can also get our text alerts at www.ratetextalerts.com. They're $7 a month. You can't beat them. You should join them. Be sure to check those out. If you're here this morning, say good morning. Welcome to all the live folks. If you're watching the replay, don't forget, do me a favor and give me hashtag replay in the comments. Let me know that you were here. Don't forget, whether you're here live or on the replay, if you're on Facebook, smash that like button, maybe tag an originator friend in the comments. If you're on YouTube, make sure you subscribe and give it a thumbs up as well. So all of that said, let's go ahead and jump in and get started. Let's see, here we go. Let me share the screen and we'll start off with what we got going on this morning. So let's pull that over, move this a little bit. All right. So quick recap, what happened yesterday. So bonds improved early in the day. You could see that right here. There was a little bit, about a half an hour when things were very calm, very quiet. And then we got a lot of improvement right here. Again, when this bond chart, when we see the lines go up, that means better rate sheet pricing. Rates are improving. We saw that go up. And again, that was yesterday after the wholesale inflation data. If we take a look over the last 5 days, you could see that we hit a low point back here on Monday. Things were really bad on Monday. Monday, we lost ground almost the entire day. We had been losing ground on Friday before that. So you could see Friday and Monday, we just seen a huge downward trend in bonds, which resulted in worse rate sheet pricing and rates pushing their way up through the week. Then on Tuesday, we got our first reprieve, and that was the big bounce up when we got the CPI inflation report. And this, I felt, if you remember, that it was overrated, that it was an overreaction. I felt like markets were being a little too optimistic based on the fact that this inflation data came out when there was a deal in place with Iran, when there was a ceasefire, when it was projected the Strait of Hormuz was opening to full capacity and had already started letting ships through. And that's no longer the case. Now, on our text advice, I had said that we could see some improvement with the PPI, the producer price index, wholesale inflation as well. And we did see that yesterday. That brought us up quite a bit. So when you look at where we were after a couple of days, here we were back up to actually a little bit better than when we started on Friday. So it really put us in a good position. But I have been over and over again saying I would lock because I don't trust these gains. This morning, we're seeing the first signs of that taking place. You can see that right here. Bonds have lost ground, and rate sheets today are likely to be worse. So after seeing rate sheets improve, arguably, we could say that they improved from hitting that high of 6.75, which I'll come back to this. But if you remember, that basically matches the worst level that we had seen back in May. So this puts us right at that same 6.75, even using Mortgage News Daily as a reference point. I know it's not an exact, but it's a really good, consistent reference point. 6.75 is that high point. And we've seen rates start to ease back after getting that inflation data. We improved a little bit on Tuesday, a little bit more on Wednesday, basically getting back that eighth of a point in rate that we had lost over the part of last week. And when you look back on mortgage-backed securities and take a look, you will see, at these technicals here, you can see that if we look at this red candlestick and the worst level that we saw on Monday, that was right here. And this is, again, the lower that mortgage-backed securities are selling for, the lower the number that we see here, the worse your pricing. You want mortgage-backed securities to sell for more money. That's more profitable. That's better rate sheet pricing. That's lower rates. The 5.5 coupon was down here last on Monday to 99.42. Not as bad as May's worst levels at 99.21, but the worst we've seen since then, 99.42. Then on Tuesday, we jumped up. A green candlestick is an upward candlestick. Remember, we start off at the body, the lower end, and we ended the day at the higher end. It was a better pricing day. Same thing happened on Wednesday. We were right here, ending back up. And, these are the levels that we started the day. These are even better. We ended at 99.97. That was basically the best we'd seen since Tuesday, July 7th. If you take a look here, we were at 99.87 and 99.86 on Wednesday and Thursday about a week ago. So we had improved to some of the best levels that we'd seen in a little over a week. Rate sheets improved. However, I felt like it was short-lived. So today, mortgage-backed securities currently down 18 basis points to start the day. Not what you want to see. Again, that's going to put us in a position where rate sheets today are going to be worse than what you saw yesterday. 10-year Treasury yield is only up a little bit, 4.59. It's really been sitting at a very stagnant level here, right around that 4.5 to 4.6 mark. So we hit our worst level on Monday, 4.62, and then 4.6 on Tuesday, 4.55 on Wednesday. We saw more of a reaction on Wednesday in the 10-year, but now it's starting to give that back. We're up to 4.59 now. So 4.59 after dropping as low as 4.55. So we're seeing that push back up as well. Again, because of this, I am in a definite locking stance. Anything closing in the next 15 days, I would definitely say that you want to lock. I'm going to go over what we saw for the headlines in a minute, but the only thing left this week, tomorrow, is consumer inflation data. Consumer sentiment data. And it's really not going to be a market mover. It's likely that for last month, we saw positive consumer sentiment because people were spending more money, because they were spending less money at the pump. But anything over the next 15 days, I would be locking. I think rates are going to creep higher. I think if we're looking at rate sheets, we're going to see them push their way back up to the 6.75 mark. And I don't think that is where things are going to end. I think we could see things get worse as we look at anything that's starting to close in August. So the next 15 days puts us through the end of July. As we get into August, we'll have new jobs data the first week of August. We'll have another CPI inflation report, and that one's going to be from July. And I think that one is not going to be received nearly as favorably. It's not going to be the savior. And this saving was only short-lived, but it's not going to be the savior. So anything over the next 15 to 30 days, I strongly consider locking. I just think we're going to be in a position in the middle of August where rates are higher than they're at right now. Unfortunately, I think we're going to see rates that are pushing back up, people. We had such promise when we started the year. We saw rates that were well into the fives, easily bought into the fives for those that didn't qualify there to begin with. And now we're back up and we're going to be at, talking about 7 again. It's going to be a tough ride. So, but anything for the next 30 days, consider locking it if you can. If it's longer than 45 days out, don't panic. But even if there's anything closing 30 to 45 days out, I would consider locking. There's just too many variables right now. So I would consider that. Now, one of the things that I'm watching, let's talk about a few different things that are going on here. The one thing that I see that I find very intriguing right now is that Brent crude, which is the oil price that I watch, ICE Brent crude, which is what the basically Brent futures are trading for, oil futures. It has been holding steady at $85 a barrel. Now, if you remember and you look at this chart here, you can see that we were well above $100 for most of the period that we have been in a conflict with Iran. And there was one time frame right here in April when we were below that $100 a barrel. Okay, let me get rid of this stuff here because it's annoying me. Okay. So right here in April, we were below $100 a barrel. That was the first time that markets thought that we were getting out of this mess and that there was going to be a deal that was had. Once we saw a deal that did take place, we saw that things did improve. We saw that oil prices steadily declined. You could see that here. They steadily declined as a ceasefire was expected. First, the original short-term ceasefire, then a longer-term deal, and it helped things improve. And if we look at where that was, the last time that we saw oil at $110 a barrel, it was actually 112, was back on May. We got 519 and 520. It was below that. So it opened at 110 on 520. And if you look at rates on 520, we have to go to here. So 5 is May. So you look at May 20th, rates were at 6.67, and they haven't really gone down much. We've talked about this. Even though we saw oil prices drop and things improve with the Strait of Hormuz, what took its place was the Fed and expectations of a Fed rate hike. And a Fed rate hike by the end of the year. And we had seen a situation where we were expecting, if you take a look here, we were expecting, look at how high this was, a rate hike in the July meeting, which is at the end of this month, was up to 40% just a few days ago. And before that CPI inflation data came out, before the PPI inflation data came out, markets were starting to lean into the idea that we could see a rate hike as soon as the July meeting. That has now, eased up and gone away. And we're in a different spot now. Now, if we take a look in July, markets are down, pricing in only about a 15% chance of a rate hike, much less expected. So this is one of the things that definitely, we're paying attention to because it's what's driving rates right now, along with what we've got going on. Now, there's very little going on the economic calendar over the next couple of weeks. So it's really, we're going to see a lot of the headlines moving things. As far as economic data, let's go ahead and go through some of these things. So yesterday we had the Fed's Beige Book. The Beige Book is basically the Fed's breakdown of the economy in the different regions across the U.S. The breakdown here was U.S. economic activity increased at a slight to moderate pace in recent weeks, with most regions experiencing little to no change in employment levels. Prices increased moderately overall. Again, that's inflation, with some contacts tying cost increases to the conflict in the Middle East and others mentioning tariffs, both of which were caused by the Orange Man. The outlook for inflation varied, with contacts in some districts expecting inflation to continue at its current pace, others expecting it to slow due to falling fuel prices. So they're very mixed as far as the belief there. This didn't move markets at all. It's just good to keep an eye on it and know what was going on. The other thing this morning, we had retail sales data come out. So retail sales found that there was consumer spending. People were spending money in other places that was freed up because gas prices had gone down. U.S. retail sales rose modestly in June, dragged down by a drop in gas station receipts that masked strong gains in some merchants. And if you take a look, 7 of 13 retail categories posted gains. Gasoline station receipts fell 5.3%, the sharpest decline since 2022. Again, that was all due to the ceasefire and the opening of the Strait of Hormuz, which we've seen reverse. The one thing that is definitely intriguing to me, oil remains at around $85 a barrel for Brent crude. when and if this goes back up over $100, up to $110, it's going to be a bad, bad situation again, something we don't want to deal with. So, other discretionary categories such as sporting goods, hobby stores, electronic and appliance stores also rose. Outlays at motor vehicle and parts dealers climbed by the most since July of 2025. Spending at restaurants and bars, the only service sector category in the retail report, edged up. So people were spending money. And strong retail sales, strong economy means the Fed doesn't need to do any Fed rate cuts. Fed rate cuts are to increase economic growth, increase economic activity. This all points to basically a flat Fed rate, not necessarily a need for a hike. Jobless claims this morning dropped down a little bit. I know that Ron and I have gone back and forth about how soft the labor market is. Numbers in the low 200s that we continue to see are not going to be enough to scare anybody at the Fed that we need to prop up the labor market by lowering the Fed funds rate. And when we see numbers like this, it supports Fed rate hikes. So keep that in mind. And this is what is likely to drive rates as we go into next week. Iran, U.S. hostilities worsen as Hormuz shipping traffic falls. Markets don't care about the bombing. They don't care about this part. What they care about is this part. Shipping traffic falls. When less oil is being moved out of the region, it's going to push up oil prices, and that's going to cause problems as we've seen before. According to Reuters has an exclusive article right now, exclusive at the moment, that Iran has told the Houthis, I don't even know how you say that one, Houthis, to close the Red Sea gateway if the U.S. hits their power network. So we're continuing to bomb. If we start bombing the power network, apparently Iran trying to get the Houthis, which are in Yemen right here, to close this choke point over in the Red Sea. And up here is where you've got the Strait of Hormuz and Iran, and everything is right here. So this is where oil ships are trying to navigate through. So Saudi Arabia moving more oil through ports in the Red Sea. And you could see that they could work with other neighbors to also let them move more oil eventually through the Red Sea, pipelines being built, etc. So the fact that Iran trying to influence the Houthis there in Yemen is a scary situation for markets, because that would lead to more of a choke point and less oil. So keep that in mind. All that stuff is what we got going on this morning. Again, overall, I just put us in a position where I think rates are not likely to improve. I would be locking anything that is closing in the next 45 days if you can. I just don't think we're in a position to see things improve. Let's go ahead and see what you guys have to say. Ron Siegel said, the markets are always smarter than the commentators. With WTI holding about 80, this tells us there is oil moving regardless of what we hear in the news. Good for markets and good for inflation, as long as it continues. So yes, I have to agree with what Ron is saying here. When we see what's going on with that price of oil, but once that price of oil breaks higher, all hell's going to come, going to break loose for mortgage rates. We're going to see rates move higher. And as far as rates go, I think we're in a position where it's very easy to see rates go ahead and move higher from here. When we're looking at what we've got going on, make myself a little small. There you go. When we look at what we've got going on, we've only seen a very nominal improvement over the last couple of days with that inflation data. Brought us back to where we were the previous week. We're back at that level, and I think we're going to see things push higher from here is what I think is going to happen. I think we're going to see rates that are going to break that 6.75 mark that we saw. And once again, I know that I'm beating a dead horse, but man, don't we all just miss the rates back at the end of February before all of this train wreck started, where we kicked the hornet's nest in Iran. Again, I know it's highly politically charged. What do you want me to tell you? It's just lamenting what's going on in our world and in our markets because of it. It's a mess. It's a mess. And an interesting article that definitely I'm looking for, I don't know if I have it open or if it was when I just, here it is. So this was this is going to play into things. Controlling Hormuz would take more U.S. troops and even more risk. The U.S. saying that we're helping ships get through, and according to oil prices, like what Ron said, maybe that's what companies are holding on to. However, when you take a look at this and you say Tuesday morning, U.S. forces radioed a message to ships gathered near the waterway. U.S. forces are prepared to maintain freedom of navigation and safeguard lawful commerce in accordance with the international law, the military said over marine radio, according to a recording reviewed by the Wall Street Journal. The southern route of the strait remains open. However, this was the response. Seafarers, jaded by deadly attacks on vessels in recent days, were skeptical. F off, one sailor is heard responding via his ship's radio. Now, again, this is great for headlines. It's one sailor, but it does represent a bigger concern, which is, do the ship owners, the ship captains, are they in agreement that there's safety to get out of there? And that's going to control where things go in the future. So keep that in mind. But Ron said, I missed the rates from 2021, but we can only deal with what we have today. That is true. That is true. Besides that, how did you enjoy the play, Mrs. Lincoln? Yeah, exactly. So, all right. Well, anyway, that's it. How did you like today's format? I kind of moved quick. I know that there was a lot to cover. So we're already 21 minutes in, and I really didn't even take a breath, and I had everything as prepped as I could for you today. So let me know in the comments if you thought today's show was cohesive, and if jumping into it early like I did was a good thing. I would appreciate your comments on that. And that is it for today, my friends. Tomorrow, we've got consumer sentiment data coming up. We'll see where we are at. I believe we're going to see bonds continue to lose ground. I think reprice risk on the day today is moderate. We could continue to see bonds losing ground today. We're already down 20 basis points. I think we could creep a little bit lower. And I think heading into tomorrow, we're going to give back more of those gains, and bonds are going to continue to lose ground. So again, I continue to be in a stance where I suggest locking everything. I think it just makes the most sense. And there you are. So thank you, Debbie Richardson. Appreciate you. Anyone else has some comments? I appreciate them as well. So, all right, everybody, make it a fantastic day. I'll see you in the morning. Bye-bye.